Okay, let's unpack this. We've got a stack of sources here, diving deep into something that's, well, it's gone from niche tech to mainstream buzz. Non-fungible tokens, or NFTs.
Yeah, it's been quite the explosion, hasn't it?
Definitely. We've seen digital art sell for, astonishing amounts. Major companies exploring some pretty wild new use cases.
And there's this whole sense of revolutionary potential, from improving digital ownership to creating entirely new forms of commerce, new ways to think about digital rights.
What's truly fascinating, and the sources really bring this out, is how quickly this technology has evolved beyond just like the initial hype around images.
Absolutely. The sources we have highlight this immense diversity in what an NFT can actually represent. It's everything from virtual real estate to event tickets, sophisticated product warranties, access passes to exclusive communities, so much more.
It really is. It's this multifaceted nature that makes them so compelling, I think.
And so complex from a rules perspective.
Right. The potential feels huge, opening up digital worlds in new ways. But, and this is the big but, right? As with any new asset class or technology that involves value, transactions, there's this massive swirling question that leaves for anyone involved. Whether you're an artist minting your first piece or an investor trading these digital assets, or even a large corporation looking at NFTs for loyalty programs or supply chains.
And that question is,
what are the tax implications? Because it's immediately obvious this isn't as simple as, say, selling a stock or a piece of traditional real estate where the rules are pretty set, pretty clear.
This really is where the complexity just hits you. Our existing tax system, it was built for a world of physical assets, right? Traditional financial instruments.
Yeah, tangible stuff, mostly.
Exactly. So trying to apply those rules to something entirely digital, that often represents this complex bundle of varied rights, and it exists on a decentralized ledger.
Yeah.
Well, it creates some significant challenges.
It goes way beyond just reporting a simple gain or loss on a purchase and sale, doesn't it?
Well, far beyond.
And that, for you, the listener, is really the mission of this deep dive. We're using the specific source material you've provided. We've got insights here from major consulting firms like Deloitte, analysis from tax experts like Clark Nuber and Token Tax, and crucially, recent signals and guidance from the IRS itself, which is key.
And we're going to navigate this complex landscape. We're going to try and cut through the jargon, get to the crucial points, and explore what taxing NFTs looks like, particularly when you move beyond those, most basic sales scenarios. We want to dig into the corporate use cases and those nuanced situations individuals face.
Yeah, and we're pulling from these diverse perspectives to hopefully give you a comprehensive understanding of the U.S. tax treatment of NFTs today, and maybe more importantly, where it seems to be headed.
Okay. All right. Before we get totally lost in the tax code maze, we really have to start at the beginning. What exactly is an NFT? The term is everywhere, but let's ground ourselves with a clear definition based on these sources. Okay. The sources provide a very helpful, pretty clear foundation.
Yeah.
At its core, an NFT is described as a unique digital identifier recorded on a blockchain.
Unique being the key word there.
Exactly. The keyword is unique. Unlike traditional cryptocurrencies, where one Bitcoin is interchangeable with any other Bitcoin that makes them fungible,
right?
Each NFT has a distinct identity. This uniqueness means it can't be replicated, and its authenticity and ownership are verifiable right there on the blockchain ledger, publicly verifiable.
Okay, so it's like a digital certificate of authenticity and ownership stamped on a public, verifiable ledger. But the sources, Deloitte especially, they emphasize it's much more than just like a static digital file, right? It's not just a fancy JPEG collecting digital dust.
Precisely. Yeah, the concept goes deeper. The sources repeatedly refer to an NFT as representing a bundle of rights that are stored within or associated with that unique digital asset.
Bundle of rights. Okay.
So while the NFT might point to a digital image or a video or a piece of music, what you actually own or have rights to through that NFT can be much, much broader.
And what kind of rights are we talking about? What's in the bundle?
Well, the sources give a whole range of examples. It could be a simple right to view the underlying digital media, or a right to use it personally.
Or more involved, like...
Right, like a right to commercialize it, essentially a license. Or it could be a right to access a specific online community or service, a right to redeem a physical item.
Like a pair of sneakers linked to an NFT. I've seen that.
Exactly. Or even a right to a future benefit, maybe like a royalty stream from future sales, or even future airdrops of other tokens.
Yeah.
The NFT is the token representing your hold on that specific bundle of rights.
And this bundle of rights idea is crucial then, because it directly impacts how the NFT is treated, both legally and, as we're about to get into, for tax purposes.
Absolutely critical.
Now, how does the smart contract element fit into this definition? I hear that term a lot.
The smart contract is, well, you could think of it as the operational brain behind many NFTs. It's described as a small piece of code, basically a program, that's written onto the blockchain alongside the NFT itself.
Okay.
This contract is signed, which makes it verifiable as originating from a specific party. And crucially, once it's deployed on the blockchain, it's typically immutable, meaning it can't be changed easily, if at all.
Ah, so that provides a level of auditability and trust, I guess.
Exactly. And the smart contract contains the data structure of the NFT and the logic that governs how it behaves. It can execute actions based on specific events, like a sale, a transfer, or maybe the automatic payment of royalties.
So it can do things automatically.
Yes. And often, the code for the smart contract is publicly visible on the blockchain, which adds another layer of transparency. The sources also mention that standards exist for these contracts, like ERC 721 or ERC 1155 on Ethereum, which helps ensure they work across different platforms.
So it's not just a static digital file and a certificate. It's dynamic, it's programmable, it's verifiable. This token on the blockchain that represents a specific set of rights and can even execute actions based on those rights.
You got it. And that programmable, unique nature is what really sets it apart from fungible tokens like Bitcoin or, traditional assets.
That combination of uniqueness and the underlying programmable contract, that's what gives NFTs their power.
And, as we're about to discuss, their tax complexity, big time.
Which leads us directly, to what the sources identify as the absolute foundational challenge for both accounting and tax professionals dealing with NFTs, figuring out definitively what's the thing.
This is the central dilemma. And the sources underscore it again and again, because an NFT can represent so many different things, that bundle of rights we just talked about.
Right.
The very first step for tax and accounting is always to look past the token itself and determine what the NFT actually gives you rights to, or maybe what obligations it might impose.
So the tax and accounting treatment doesn't just depend on calling it an NFT. It hinges entirely on this underlying definition, on the rights and obligations attached to it.
Precisely. You absolutely have to understand the substance of the transaction and the asset represented by the token. You can't just look at the label.
And the examples the sources provide really highlight this diversity. It could be treated as simple property, right? That seems like a common default.
Yeah, that's often the default classification if the NFT primarily grants general viewing or use rights, or maybe if it involves the outright transfer of intellectual property. Just straightforward ownership of something.
Or it might represent a license.
Right. Particularly if the NFT grants broad rights, maybe perpetual or commercial rights, to use content without transferring full ownership of the underlying IP itself. Think stock photos, but on the blockchain maybe?
I saw in one source that it could function like a club membership. That's interesting, like granting access to an exclusive online community, a Discord server, or even real-world events.
Yes, exactly. And the rights granted by that membership could be ongoing, not just a one-time thing. Another possibility raised is that an NFT could represent a prepaid subscription or service.
Oh, okay. How would that work?
Well, if holding the NFT grants you access to, say, an online service for a period, it might even be treated periodically for revenue recognition or income purposes, kind of like how a traditional software subscription is handled.
Or it could be tied to the physical world, maybe acting as a commercial receipt, giving you rights to redeem a physical good or service.
Right. That sneaker example again. Or, and this is where things get even more complex, it could represent a financial instrument.
A financial instrument? How so?
Well, this can happen if the NFT holders have rights to, say, revenue shares generated by a project or other income streams, or if the NFT structure starts to look a lot like a partnership interest, or even an equity right in some underlying venture. That starts smelling like securities territory.
Definitely. And of course, for artists or creators who are regularly minting and selling their own work as NFTs, the source notes that for tax purposes, the NFT could simply be treated as inventory.
Yeah, just like a physical artist might treat their unsold paintings in their studio. It's stock in trade.
The range is truly vast. And the critical point, the why this classification matters so much, is because this initial determination of what the thing is dictates almost everything that follows from a tax perspective, right?
It really does. It impacts how you recognize revenue, when, and how much. It impacts the sourcing of that income, which is especially tricky in international transactions.
Where did the sale technically happen?
Exactly. It affects whether international reporting obligations apply, what kinds of transaction taxes might be relevant, like sales tax, though that's often complex for digital goods anyway, and crucial information reporting and withholding requirements too.
So the documentation isn't just legal boilerplate then. The specific terms of use, the sale agreements, maybe even the language used in marketing materials when the NFT is sold. All of that can effectively define the bundle of rights and heavily influence how the IRS or other tax authorities classify it.
Absolutely critical. Yeah, the terms and conditions attached to the NFT are paramount in defining those underlying rights, and that definition is paramount in determining the tax treatment. Read the fine print.
Okay, so we understand what an NFT is, sort of, and why defining it is the fundamental challenge. Let's move into the actual life cycle of an NFT from a tax perspective. How are these transactions taxed, starting with creation, moving through sales, and maybe other potential events?
Okay, let's begin with the creation process itself, which is often called minting an NFT. The sources generally agree on this. The act of minting the NFT in and of itself is typically not a taxable event.
Not taxable. Why not?
Because you're essentially just bringing an asset into existence. You haven't yet sold it, exchanged it, or disposed of anything of value for consideration. Nothing's really happened yet from a value exchange standpoint.
But there are costs associated with minting, right? Like the gas fees paid to the blockchain network to process the transaction. Those aren't free.
Yes, and this is a crucial point where a taxable event can occur during the minting process itself. If those costs, those gas fees, are paid using cryptocurrency, which they almost always are.
Right. You usually pay an ETH or something similar.
Then paying that fee is considered a disposition of the cryptocurrency you used. You're using that crypto as payment for a service, the minting process.
Okay. So the transaction isn't the creation of the NFT being taxed, but the spending of the crypto to facilitate that creation, that's the taxable bit.
Exactly. If the cryptocurrency you use to pay the gas fee has appreciated in value since you acquired it, well, using it to pay the fee triggers a capital gain, or potentially a loss, on that specific amount of crypto at the moment it's spent.
Even if it's a small amount?
Even if it's small. It's a transaction, maybe tiny, but technically a taxable one. You need to track that.
Got it. Minting itself, not taxed. Crypto used for costs, potentially taxed. Clear distinction. Now, what about when a creator sells an NFT they made, say a digital artist?
Right. If you are a creator, maybe the digital artist, and you're regularly creating and selling NFTs as part of your ongoing activities, basically, as a business or your livelihood.
Your job, essentially.
Yeah. The sources indicate that the profits from those sales are generally treated as self-employment income.
Self-employment income. Okay, what does that mean for the tax rate specifically?
It means the income is subject to your ordinary income tax rates, which, can go up to 37% in the highest federal brackets currently.
Yeah.
And this is the kicker.
Yeah.
It's also subject to self-employment tax.
Which covers Social Security and Medicare for self-employed folks.
Correct. The base rate for self-employment tax is 15.3%, although there are some limits and deductions involved. So for a creator selling their work as a business, the tax can be pretty substantial. You've got ordinary income tax and self-employment tax. The assets they create, those NFTs, are basically treated like inventory in a traditional business.
So if you're making a living as an NFT artist, it's taxed pretty much like running any other kind of small business. Are the expenses of creating the art deductible in that scenario, software fees, etc.?
Yes, absolutely. If you're operating as a trade or business, you can deduct ordinary and necessary expenses related to that business activity. That would include your costs of creation software, maybe hardware, subscriptions, the blockchain costs like minting and listing fees, maybe marketing costs, other expenses directly related to selling your work.
And your tax basis in the NFT as the creator would be what?
Your basis would essentially be the sum of those costs and expenses incurred in bringing it into existence and getting it ready for sale.
Okay. And the sources mentioned something about installment sales potentially being available for creators. How does that work?
Yes, this is noted as a possibility for certain creators, particularly if they structure a sale where payment is received over multiple tax years. If the sale qualifies as an installment sale under the tax rules, and there are specific rules for that,
right,
it could allow the creator to recognize the income from the sale over the period they actually receive the payments, which could potentially smooth out the tax burden instead of taking one big hit in the year of sale.
Okay, that's for the creator operating as a business. What about the other side? Someone who buys an NFT purely as an investment, maybe hoping it appreciates and then later sells it.
For an investor, yes, selling an NFT is generally treated like selling any other piece of investment property. It's pretty similar to selling stocks, bonds, or maybe investment real estate.
So you calculate a gain or loss.
Exactly. You realize a capital gain or loss calculated is the difference between the amount of consideration you receive for the NFT, basically the sale price, and your tax basis in it.
And the basis for an investor is typically just what they paid for it.
Correct. Your basis as an investor is your purchase price. And crucially, this should include any associated fees paid at the time of acquisition, like maybe platform fees or gas fees related to the purchase.
Documentation again?
Oh, absolutely. The sources strongly emphasize the critical importance of meticulous record keeping here. You absolutely need to document exactly what you paid, including all those fees and the date of purchase. This is essential to accurately calculate your basis when you eventually sell.
What happens if you don't have good records?
Well, it can be very difficult, maybe impossible, to prove your basis. The IRS could potentially assert a basis of 0, meaning your entire sale price gets treated as taxable gain. So keep those receipts.
Ouch. Okay, so assuming you have your basis figured out, is that gain taxed at capital gains rates?
Yes, it is. The resulting gain or loss is a capital gain or loss. And the tax rate depends on your holding period, basically, how long you own the NFT before you sold it.
Short-term versus long-term.
Exactly. If you held it for 1 year or less, it's considered a short-term capital gain or loss. Short-term gains are taxed at your ordinary income tax rates, same rates as your salary, for instance.
Okay.
But if you held the NFT for more than 1 year before selling, it qualifies for long-term capital gain or loss treatment. Long-term capital gains are subject to potentially lower tax rates, currently 0%, 15%, or 20%, depending on your overall taxable income level.
Which is usually better than ordinary rates.
Generally, yes. However, and this is the big one we flagged earlier, and the sources really dive into it, there's a major caveat here. If the NFT gets classified as a collectible, that could push the rate higher.
Right, that 28% rate, we definitely need to circle back to that. But first, let's talk about one of the most common scenarios that seems to confuse people. Buying an NFT using cryptocurrency, like paying for a piece of digital artwork with Ethereum. What happens from a tax perspective right then?
This is a critical point that, as the sources note, often trips people up. It feels like one transaction, but for tax purposes, when you use cryptocurrency to purchase an NFT, you are actually triggering 2 distinct taxable events at the same time.
2 events. Okay, walk me through that.
All right. The first event is the disposition of the cryptocurrency you're spending. The IRS views using crypto to buy goods or services, and that includes other digital assets like NFTs, as effectively an exchange or sale of that crypto.
So just spending the crypto is like selling it?
In the eyes of the IRS, yes. If the cryptocurrency you're spending has increased in value since you originally acquired it, using it to buy the NFT triggers a capital gain on the crypto itself at that moment, or a loss if it went down.
Okay, so step 1, spending the crypto is treated like selling it, and any appreciation is taxed right then. Got it.
Exactly. You have a capital gain or loss on the amount of crypto used based on its fair market value at the time of the transaction compared to your basis in that specific crypto. The sources use relatable examples, like buying shoes with Bitcoin. That's a taxable event on the Bitcoin. Same logic applies if you buy a Bored Ape NFT with ETH.
Okay, and what's the second taxable event happening simultaneously?
Step 2 happens immediately. You are simultaneously acquiring the NFT. Your tax basis in the newly acquired NFT is the fair market value of the cryptocurrency you spent, plus any associated transaction fees at the time of the purchase.
Wow, okay. So you could potentially owe tax on the crypto you spent just to buy the NFT? And then later, if the NFT itself appreciates and you sell it, you could owe capital gains tax on the NFT's appreciation too.
That's exactly right. It can feel like a double layer of tax, even though technically it's 2 separate transactions involving 2 different assets.
Yeah, that makes sense. It underscores why tracking your crypto cost basis and the value at every transaction is so incredibly important.
Absolutely essential. Can't stress it enough.
What about trading one NFT directly for another NFT? No crypto involved, just a swap.
That's also considered a taxable event. It's treated as a property-for-property exchange under the tax code.
So it's like selling the old one.
Effectively, yes. When you exchange one NFT for another, you're treated as selling your old NFT for the new NFT. The fair market value of the new NFT you receive is considered the consideration or sale price for the old one.
Okay.
So you calculate a gain or loss on the old NFT based on that fair market value compared to your basis in it. And then the fair market value of the NFT you received becomes your new tax basis in that new asset going forward.
That sounds tricky if the NFTs don't have a clear market price, like if it's a private trade.
It can be very challenging. The sources suggest that obtaining a third-party appraisal might be necessary for significant non-cash exchanges like this to support the valuation you use for tax purposes. Otherwise, how do you prove the value?
Good point. And what about receiving royalties as a creator? If the smart contract is set up to automatically send you, say, 10% of every secondary sale forever, how's that taxed?
The sources note that specific IRS guidance on NFT royalties is still lacking, unfortunately. But the likely treatment for a professional creator would be ordinary income.
Ordinary income again.
Yeah, similar to their initial sale proceeds, and likely subject to self-employment tax as well, because it's derived from their professional activity, their creation.
Even though it feels passive once the contract is set.
Probably.
Yeah.
Given it stems directly from their business asset. Now, if it were a truly passive, maybe one-off situation for someone not in the business, it might potentially be reported as passive income on Schedule E, perhaps? But for active creators, that self-employment treatment seems much more probable given the ongoing nature of the income from their created asset.
Okay, this is definitely complex enough already, but let's dive into that big point we've hinted at a few times. The collectibles question and that potential 28% tax rate. This is higher than the standard long-term capital gains rates we talked about.
Yes, this is a major point of focus in the sources, and frankly, a significant area of continuing uncertainty for investors. So the U.S. tax code generally gives preferential rates to long-term capital gains profits from selling assets held more than a year, right? Those 0%, 15%, or 20% rates.
Yeah.
However, there's a specific exception carved out for collectibles. Long-term gains from selling collectibles are taxed at a maximum rate of 28%. That can be significantly higher than the standard rates, especially for higher income earners.
And the IRS has specifically signaled that some NFTs might fall into this higher taxed collectibles category.
Absolutely. IRS Notice 2023-27 is the key document here.
Yeah.
In this notice, the IRS clearly stated its intention to issue formal guidance, regulations probably, that will treat certain NFTs as collectibles for purposes of Section 408 meters of the Internal Revenue Code.
And that section is what defines collectibles and triggers the higher rate.
Exactly. That section lists things like art, rugs, antiques, metals, gems, stamps, coins, and also catches certain other tangible personal property. Linking NFTs to this section is the mechanism for applying the 28% rate.
So how does the IRS plan to figure out if a specific NFT is a collectible? Do they look at the token itself or what it represents?
This is where the notice introduces what they're calling a look-through analysis. It's a key concept. Pending the formal regulations, the IRS intends to determine if an NFT is a collectible by looking through the token to its associated right or asset.
Okay, look through the NFT.
The fundamental question is, if you look at the NFT, what is the underlying item or right that it represents? If that underlying item or right is something already defined as a collectible under the existing tax code, then the NFT itself will be treated as a collectible for the purpose of that 28% long-term capital gains rate.
Okay, let's take a clear example from the sources.
Yeah.
If you have an NFT that represents direct ownership of, say, a physical gem, like a specific ruby or a sapphire.
That's a perfect example to use. Gems are explicitly listed as collectibles in the existing tax code section 408 meters. So under this look-through analysis outlined in Notice 2023-27, an NFT that certifies or represents ownership of a physical gem would pretty clearly be considered a collectible.
Meaning, selling that NFT after holding it for more than a year would likely subject the long-term gain to that higher 28% rate.
That's the strong implication, yes.
And conversely, if the underlying asset isn't a traditional collectible, then the NFT wouldn't be either.
Generally, that's the idea. The notice gives the example of an NFT representing virtual land within a metaverse.
Like Decentraland or Sandbox Land.
Right. Virtual land doesn't fall into any of the existing tax code categories for collectibles. It's not a work of art, a rug, an antique metal gem, stamp, coin, or other tangible personal property. Therefore, an NFT representing virtual land would generally not be considered a collectible under this analysis. The standard long-term rates would apply.
Okay, but this is where it gets really interesting and frankly still quite ambiguous, isn't it? What about NFTs where the associated asset is a digital file itself, like a digital image that many people would absolutely call art, or maybe a digital trading card? The sources highlight this as a major gray area the IRS is still grappling with.
This is the big question mark, especially for the huge market of digital art, NFTs, PFPs, generative art, etc. Notice 2023-27 specifically mentions that the IRS currently believes digital files don't fit into categories like rugs, gems, stamps, because, well, they aren't tangible personal property.
Right, they're digital.
The key ambiguity, the hinge point, is whether a digital file can be considered a work of art for tax purposes.
Yeah.
Work of art is a defined collectible category in Section 408 meter. The IRS is actively considering this and specifically asked for public comments on this exact issue.
So it's not settled yet. Does a digital painting by Beeple count as a work of art in the same way a physical painting by Picasso does under this specific tax rule?
That is the core question they are debating internally and asking for input on. Until formal guidance is issued, there's just uncertainty. Some tax experts, reading the tea leaves from the notice and the nature of many digital art NFTs, suggest that taking the conservative position might be prudent.
Meaning assume the 28% rate could apply.
Yeah, assuming the 28% rate could apply to long-term gains on these digital art NFTs, especially if the image is something that would clearly be considered art if it existed in the physical world. But again, the final rule is still pending. It could go either way.
And what about even more complex scenarios the sources mentioned? Like, what if the NFT doesn't grant full ownership, but just, say, personal use rights to view a digital file? Does the look-through still apply?
That's a great question.
Or what if the NFT represents a bundle of rights, some of which might look like a collectible, like an image, but others clearly don't, like access to a members-only community or future game benefits? How do you split that?
These are precisely the kinds of complex edge cases the IRS is seeking input on. How do you apply the look-through analysis when the rights are fractional, or when the NFT grants multiple diverse rights? What about situations where owning the NFT leads to receiving other assets or rights later, maybe through an airdrop, even if it wasn't a contractual guarantee from the start?
So many variables.
Right. Notice 2023-27 specifically raises these scenarios as needing clarification. The look-through idea provides a framework, a starting point, but applying it consistently to the diverse and constantly evolving landscape of NFT utility is going to be a massive undertaking for them.
It really sounds like the determination of whether an NFT is a collectible is going to end up being a highly facts and circumstances-based test once the final rules are actually out.
It certainly appears that way. The specific nature of the underlying asset or the bundle of rights, as defined by the NFT's terms, its smart contract, its marketing, all that documentation we talked about, that will likely be paramount.
This all just points to a regulatory landscape that is anything but settled, doesn't it? It feels very much in flux.
Absolutely. The sources, particularly the analysis from firms like Deloitte, really emphasize that the regulatory environment for NFTs and digital assets generally is still taking shape. It's subject to rapid evolution. Companies and individuals involved in this space need to be agile. They need to be prepared to adapt as guidance comes out.
And regulators seem to be looking closely at the function and purpose of specific NFTs and platforms, not just applying a broad brush label.
That's right. They're digging into the use cases.
Beyond tax, I saw mentions of securities concerns popping up quite a bit. How can an NFT actually trigger securities laws? That seems like a different world.
It is, but they could definitely overlap. This is a major risk area discussed in the sources. In the U.S., the standard legal test for determining if something is an investment contract and therefore a security subject to SEC regulation is called the Howey test.
Right, the Howey test. Heard of that.
It generally involves three things: an investment of money in a common enterprise with a reasonable expectation of profits derived primarily from the efforts of others, usually the promoter or issuer.
Okay.
So if an NFT is structured or marketed in a way that looks like this, for example, if the issuer promises future revenue shares or royalties based on their ongoing efforts, or pools investor funds to build something where the NFT holders expect a profit based on that building.
Like investing in a company's stock.
Kind of, yeah. If it functions like that, it can trigger securities laws. And the sources specifically note that fractionalizing NFTs, breaking them into smaller, more affordable pieces, significantly increases the likelihood of them being viewed as securities because they start to behave much more like shares in an underlying asset or venture.
So if you issue an NFT collection and tell people, hey, buy this NFT and you'll get a cut of our future game profits, that's a big red flag for the SEC.
Exactly. The focus is on the nature of the promise being made and the expectation of profit driven by the issuer's continuing efforts, not just the value of the NFT itself appreciating on its own.
What about being treated as a commodity, like Bitcoin or Ethereum sometimes are by the CFTC? Can an NFT be a commodity?
It's less common right now. While most NFTs aren't currently used as mediums of exchange in the way fungible cryptocurrencies like Bitcoin or Ether are.
They're unique, right?
They're unique. But the sources raise the point that if a particular class of NFTs were to start being used widely and functionally as money or maybe a store of value, regulators like the CFTC could potentially consider them commodities down the line. Furthermore, issuing NFTs that function in a money-like way could require compliance with state-level money transmitter licenses, or MTLs.
Which are a whole different set of complex regulations.
A very complex regulatory hurdle.
It really all comes back to the function and the use case, doesn't it? How is the thing actually being used?
Fundamentally, yes. Regulators seem less concerned with the underlying blockchain technology itself and much more concerned with how it's being used and what rights or expectations it creates for buyers and sellers. Substance over form again.
And beyond these big regulatory classification issues, the sources also discuss some pretty significant practical risks for users and platforms, things like cybersecurity, fraud, platform failure.
Absolutely. Consumer and investor protection is a growing priority for agencies like the SEC, the CFTC, and also the FTC, the Federal Trade Commission. The sources highlight that while the blockchain technology itself is often quite secure,
the ledger is hard to hack.
Right, but the vulnerabilities frequently lie in the interfaces, the wallets, the websites, the platforms that users interact with. Those are susceptible to hacking, phishing attacks, scams, fraud, you name it.
We hear about those constantly.
Yeah. And high-profile hacks or rug pulls where developers abandon a project and run off with funds inevitably draw increased regulatory scrutiny regarding what issuers disclose, what promises they made.
There's also a risk mentioned that the actual digital content linked by the NFT could just disappear.
A very real risk, and one people maybe don't think about enough. The sources explain that the actual digital media, the image file, the video, the music, it's typically not stored directly on the blockchain itself. It's usually too big and expensive.
So where is it?
The NFT on the blockchain usually just contains a pointer, like a link, maybe a URL or an IPFS hash, to where the content is hosted somewhere else. Often on a traditional web server, or maybe a decentralized storage network like Filecoin or Arweave.
But what if that server goes down?
Yeah.
Or the company stops paying the hosting bill?
Exactly. If that hosting entity goes down, shuts off, or the link breaks for any reason, the NFT may suddenly point to nothing. It loses its associated visual or audio component. This is a significant difference from, say, owning a physical piece of art hanging on your wall.
Yeah, the painting doesn't just vanish.
Right. So doing due diligence on how the underlying content is stored, who controls it, and what rights you actually have to it is crucial. Is the storage permanent? Who guarantees it?
It seems like engaging with NFTs, especially for companies, involves navigating not just tax and securities law, but this whole tangled web of potential risks and maybe even licensing requirements.
It absolutely does. The sources really emphasize the need for comprehensive risk management frameworks. Companies need to think about everything from smart contract vulnerabilities and auditing to platform reliance to ensuring they have clear rights to the underlying media they're tokenizing.
Okay, let's shift focus slightly to the corporate side. Beyond the individual creator or investor, there are some significant accounting considerations for companies that might issue NFTs, hold them as investments, or maybe facilitate NFT transactions on a platform.
Yes, this is another area of significant complexity discussed in the sources, particularly Deloitte's insights. Just like with tax, the accounting treatment for an NFT isn't a simple one-size-fits-all approach.
Not just debit cash, credit NFT revenue.
Definitely not always that simple. While generic fungible cryptocurrencies are often accounted for as intangible assets under current US GAAP.
Which has its own issues, like impairment testing, but no upward revaluation.
Right. But the accounting for an NFT depends entirely on what that NFT represents. Is it an asset the company controls? Is it granting a license? Is it a prepaid subscription? A right to future goods or services? The accounting follows the substance.
So accounting also needs to figure out what's the thing first.
Exactly the same starting point. For a company, the key accounting questions are, what specific rights are being granted to the NFT holder? What obligations does the company issuing or holding the NFT have? And what is the company's role in the ecosystem? Are they the direct issuer, just holding NFTs as an investment, or are they providing a platform that facilitates transactions between others?
And the specific terms within the NFT's smart contract and those associated agreements seem to have a huge impact on how a company recognizes revenue from NFT sales, right?
A massive impact. Yeah, the sources highlight that the accounting treatment, particularly for revenue recognition under the big standard ASC 606, depends heavily on these details. For instance, is the company selling outright ownership of some content versus merely granting a license to use it? That can change the timing and pattern of revenue recognition.
Other factors matter too.
Oh, yes. Who has discretion over the use or pricing of the underlying rights? Is the payment received fixed or variable? And does the NFT represent a bundle of distinct rights or services that should maybe be accounted for separately as multiple units of account or performance obligations?
Like breaking out different parts of the value.
Exactly. Even small changes in the contract language can significantly alter how and when a company recognizes revenue from an NFT sale.
So let's say a company sells an NFT that gives you a piece of digital artwork and grants you access to a special members-only website for a year. Those might need to be accounted for as two different revenue streams or deliverables.
Potentially, yes. Under ASC 606, if those rights or services are distinct, meaning the customer can benefit from them separately or with other readily available resources and provide separate value, accounting rules might require them to be treated as separate performance obligations. Each might have its own revenue recognition pattern. Maybe the art revenue is recognized up front, but the website access revenue is recognized over the year.
Wow, that adds layers of complexity to the accounting department's job.
It really does, especially for ongoing rights or services bundled with the initial NFT sale.
And the role of external platforms like OpenSea or Foundation is also key for corporate accounting if a company uses them.
Crucial. If a company uses a third-party marketplace or platform to sell its NFTs, that platform's role significantly impacts the company's revenue recognition. The key question is the platform acting as a principal in the transaction or merely as an agent?
Principal versus agent.
Yeah.
What's the difference there?
A principal typically obtains control of the NFT or the underlying content before selling it to the end user. An agent simply facilitates the transaction between the company and the buyer without ever taking control.
And why does that matter for revenue?
It determines whether the company reports the gross sales price as its revenue, if it's acting as the principal, or only its net fee or commission, if it's acting as the agent. This can have a huge impact on reported top-line revenue numbers. Managing bundled rights where the platform is involved can also create complex accounting considerations about who is responsible for delivering what.
It really sounds like any company seriously looking to integrate NFTs into its business model needs its accounting and tax teams involved right from the very beginning, like in the product design phase.
The sources strongly advise this. Trying to retrofit the accounting and tax treatment onto an already launched NFT project is far, far more difficult and riskier than designing the NFT and its associated terms with these considerations baked in from day one. Get the accountants and lawyers in the room early.
Good advice. Looking ahead now, one major development flagged in pretty much all the sources is the significant increase in information reporting that's coming for digital assets, and that includes NFTs.
This is a huge shift, yeah. A really big deal for the space. The Infrastructure Investment and Jobs Act of 2021 included provisions that mandate brokers who facilitate digital asset transactions report those transactions to the IRS.
Using forms similar to how stock sales are reported by brokerages.
Exactly the analogy. Think Form 1099-B that you get from your stockbroker listing your sales, proceeds, and maybe cost basis. The idea is to have something similar for digital asset transactions.
And who counts as a broker under this new rule? Is it just the big crypto exchanges?
Well, the definition of broker for digital assets in the law is actually quite broad. It's expected to include not just centralized crypto exchanges, but also platforms that facilitate exchanges of NFTs and potentially even other players in the ecosystem, depending on how the final regulations are written.
And when does this reporting start?
The law states that this new reporting requirement applies to information returns required to be filed after December 31st, 2023.
Okay, so platforms will likely start reporting transactions that occurred in 2023 calendar year, with those reports, like the 1099-Bs, being issued to users and the IRS sometime in early 2024.
That's a general timeline intended by the law, yes. Now, the IRS and Treasury are still working on issuing the final regulations that will provide the specific, detailed implementation guidance for these brokers. There's been some delay and back and forth on the exact rules, but the statutory mandate is there. The overall move towards widespread third-party information reporting for digital assets is definitely happening.
So what does this mean for you, the individual listener who maybe uses these platforms to buy or sell NFTs?
Well, the most immediate impact is a significant reduction in the perceived anonymity that some users may have previously experienced with digital asset transactions. The IRS will start receiving data directly from exchanges and platforms about your sales, your proceeds, and potentially other dispositions of digital assets, including NFTs.
So if I sell an NFT on a major marketplace like OpenSea or Magic Eden, that marketplace will likely be reporting that sale, the date, the proceeds directly to the IRS under these rules.
That is the clear direction and intent of the legislation, yes, subject to the final details in the regulations, but that's the expectation.
Now, does this mean that if I don't get a 1099-B from a particular platform, maybe a smaller one, or for a specific transaction, does that mean I don't have to report the transaction myself on my tax return?
Absolutely not. And the sources are crystal clear on this point. This is perhaps one of the most important takeaways for individuals listening. Your obligation as a U.S. taxpayer to report your taxable income, your capital gains, and your losses to the IRS exists completely independently of whether or not you receive any official tax form like a 1099.
The reporting obligation is on me regardless.
Yes. Transactions that happen on decentralized marketplaces, maybe peer-to-peer exchanges, swaps directly between individuals, or activity that happens solely within your own private wallets. Those are still fully reportable by you, the taxpayer, if they result in taxable gain or loss.
So the absence of a 1099 doesn't make it tax-free?
Not at all. It doesn't mean the transaction isn't taxable or doesn't need to be included on your tax return. The broker reporting simply makes it easier for the IRS to cross-reference data and potentially identify non-compliance. But the ultimate responsibility for accurate reporting always lies with the taxpayer.
That's a critical point. So regardless of how you transact with NFT's centralized platform, decentralized private wallet meticulous documentation is essential because you are likely responsible for reporting it yourself anyway, 1099 or not.
Meticulous record keeping remains absolutely paramount. It's your only defense, really, and your ability to accurately calculate your gains and losses. Don't rely on platforms to do it all for you, even if they start issuing forms.
Okay. Given all this complexity, the reporting requirements, the potential tax liabilities, let's talk about strategies. Are there ways you can potentially reduce your NFT tax bill? And the sources are careful to note these aren't, magic loopholes, but strategies within the existing tax framework.
Correct. These are legitimate ways to manage your tax liability, not about avoiding taxes owed. One fundamental strategy, especially for investors, is simply to aim for long-term capital gains treatment whenever possible.
Which means holding the NFT for over a year before selling?
Exactly. As we discussed, holding an investment asset for more than 12 months before you sell it generally qualifies any resulting gain for those potentially lower long-term capital gains rates, the 0%, 15%, or 20% brackets, as opposed to your higher ordinary income rates.
That alone can result in significant tax savings, right?
It can, unless, of course, the asset is classified as a collectible, in which case the maximum rate jumps to 28%. But even 28% is often lower than the top ordinary income tax rate, plus self-employment tax, if that were applicable. So patience can definitely be a tax-savvy move for investors.
What if an NFT you invested in doesn't do well? It loses value. Can you get any tax benefit from that situation?
Yes, absolutely. Selling an NFT for less than your tax base is what you paid for it, including fees, allows you to realize a capital loss.
And how do capital losses help?
Capital losses are valuable because they can be used to offset any capital gains you might have from selling other assets, other crypto, stocks, bonds, other NFTs, investment real estate. You net your gains and losses.
What if you have more losses than gains in a year?
If your total capital losses for the year exceed your total capital gains, you can deduct up to $3,000 of that net loss, $1,500 if you're married filing separately, against your ordinary income, like your salary.
Okay, a $3,000 deduction against ordinary income.
Right, and any remaining net loss above that $3,000 limit isn't lost. It can be carried forward indefinitely to offset capital gains in future years, and potentially up to $3,000 per year against ordinary income in those future years as well. So realizing losses can be beneficial.
And there's a notable difference compared to traditional stocks when it comes to tax loss harvesting with crypto and NFTs, related to something called the wash sale rule.
Yes, this is a significant point highlighted in the sources, and it offers some unique flexibility currently in the crypto and NFT space. In traditional finance, with stocks and securities, there's the wash sale rule.
What does that rule do?
It's designed to prevent investors from artificially generating tax losses. It says you can't claim a tax loss on selling a security if you buy back that same security, or a substantially identical one, within 30 days before or after the sale.
So you can't just sell your losing Apple stock on Monday buy it right back on Tuesday and still claim the tax loss from Monday's sale. You have to wait.
Exactly. You have to be out of the position for at least 31 days around the sale date to claim the loss. But here's the key difference. Currently, because cryptocurrency and NFTs are generally treated by the IRS as property, not securities.
Like gold or art, not like stock.
Right. The wash sale rule, which is defined at a specific tax code section 1091 that applies only to securities and certain contracts and options on securities, does not currently apply to them.
That's really interesting. So does that mean I could theoretically sell an NFT at a loss, realize that loss for tax purposes to offset gains, and then buy that same unique NFT, or maybe a similar one from the same collection, back relatively quickly if I wanted to maintain my position or felt it might recover?
Currently, under the existing law as interpreted, yes. The specific wash sale rule restriction doesn't apply to property like crypto and NFTs. This does offer investors a window for tax loss harvesting strategies that just aren't available with stocks and bonds. You could potentially sell a losing NFT, claim the loss, and buy it back relatively soon after without violating the wash sale rule itself.
Now, are there any other potential IRS challenges to doing that? Even if the specific wash sale rule doesn't apply, could they still disallow the loss?
It's possible, though less defined. The sources mention that while the wash sale rule itself is out, the IRS could potentially still challenge a loss under broader tax doctrines if the transaction is viewed as lacking economic substance or not being a bona fide sale, particularly if the repurchase happens almost instantaneously or as part of a prearranged plan that doesn't genuinely change your economic position or risk.
So maybe don't buy it back 5 seconds later.
Probably wise to allow some time to pass and ensure the sale is genuine. But the 30-day rule isn't the specific hurdle here as it is with stocks. It's certainly more flexible currently, though future legislation could change this.
Okay, another strategy mentioned is charitable donations. Can you donate an NFT to charity and get a tax deduction?
Yes, you absolutely can donate appreciated NFTs that have gone up in value directly to a qualified U.S. charity, like a 501c3 organization.
And what's the tax benefit?
If you donate an asset, like an NFT that you've held for more than 1 year, making it long-term capital gain property, and it would have generated a gain if you had sold it, you can potentially deduct its full fair market value at the time of the donation. This deduction is subject to certain income limitations, but it can be a very tax-effective way to support a cause you care about while avoiding the capital gains tax you would have paid if you sold the NFT first.
That sounds like a win-win. Are there any pitfalls to watch out for?
Yes, the sources provide a critical warning here. The donation must be structured correctly. Ownership really needs to transfer cleanly.
What's the potential problem?
The pitfall is if you, the donor, essentially pre-arrange the sale of the NFT before formally donating it, or if the IRS views you as having effectively sold the NFT yourself and then just donated the cash proceeds to the charity. This can happen if you facilitate the sale too closely, or if ownership isn't clearly and fully transferred to the charity before any sale process begins.
What happens if the IRS sees it that way?
If the IRS takes that view, you could be treated as if you sold the NFT first. That means you would owe the capital gains tax on the appreciation, and your charitable deduction would only be for the cash proceeds eventually given to the charity, not the potentially higher fair market value of the NFT before the sale.
So the key is make sure the charity fully owns and controls the NFT before they decide to sell it or auction it off.
Exactly. The charity needs to have the independent right to decide whether and when to sell the donated asset. Get good advice on the transfer mechanics.
Okay. What about gifting NFTs to other individuals like family or friends? Can that help with taxes?
Gifting NFTs to other individuals can, in certain circumstances, be a way to manage potential future tax liabilities compared to selling the NFT yourself. Gift tax rules would apply. There are annual exclusion amounts and lifetime exemption limits. But depending on the value of the gift and perhaps the recipient's tax bracket, if they eventually sell it, it might result in a lower overall tax burden across the family unit compared to the original owner selling and paying the gain. The recipient generally takes the donor's basis, though.
And using tax-advantaged accounts like IRAs, can you hold NFTs in those?
The sources briefly mention this possibility. Utilizing accounts like self-directed IRAs could potentially allow for tax-deferred or tax-free growth on NFT investments, depending on the account type, traditional versus Roth. However, this area is quite complex.
Why complex?
Well, self-directed IRAs have strict rules, particularly around prohibited transactions, things you can't do with the account funds, like self-dealing. Also, investing IRA funds in collectibles, as defined by that same Section 408 meter, is generally prohibited and comes with significant penalties.
So we're back to that collectibles classification challenge again. If an NFT is deemed a collectible, you probably can't hold it in an IRA.
That's the major concern, yes. Given the uncertainty around whether many digital art NFTs are collectibles, holding them directly in an IRA seems risky right now. It might require careful structuring or specific types of NFTs that are clearly not collectibles. Definitely needs expert advice.
So maybe not a widely applicable strategy for most NFTs at the moment.
Likely requires very careful consideration and might not be suitable for typical art or PFP NFTs until the collectible guidance is clearer.
Okay, let's quickly round things out with a few other specific tax details for NFTs mentioned in the sources. We already touched on gas fees paid with crypto being a taxable event on the crypto itself, but maybe just reiterate how those costs factor in.
Yeah, it's worth repeating. Any transaction fee paid using crypto, whether it's a gas fee for minting or transferring an NFT, or maybe a platform fee paid in crypto, triggers a taxable disposition of the small amount of crypto used for that fee. You need to calculate the gain or loss on that crypto at the time it's spent and keep track of it. Those fees might add to the basis of the NFT acquired or be deductible business expenses for creators, but the crypto spend itself is step one.
Okay. What about receiving NFTs for free, like in an airdrop from a project or maybe as a reward for doing something?
Receiving an airdropped NFT, or one received as a reward or for services, is generally treated as taxable ordinary income at the time you receive it.
Ordinary income. Based on what value?
The amount of income you recognize is the fair market value of the NFT on the date you receive it and have control over it. That value also becomes your initial tax basis in the NFT for calculating gain or loss if you later sell it.
So tracking the date and the fair market value at the time of any airdrop is crucial for compliance, even if you didn't pay for it.
Absolutely crucial. If it has value when you get it, the IRS considers it income.
And finally, this is a tough one. What about losses that don't come from selling? What if an NFT project just fails and the NFT becomes worthless? Or if your NFT is stolen in a hack or scam, how are those kinds of losses treated?
This is a really complex and often unfavorable area for individual investors, unfortunately. The sources note that claiming a tax loss typically requires a closed and completed transaction, which usually means a sale or exchange.
And worthlessness or theft isn't a sale or exchange.
Exactly. Simple abandonment or an asset just becoming worthless on the market or being stolen. These don't involve a sale or exchange in the typical sense. Therefore, it's much less clear how these losses are treated for tax purposes.
So what might happen?
For individuals, these types of losses might potentially fall into the category of miscellaneous itemized deductions. However, under the current tax law resulting from the Tax Cuts and Jobs Act, most miscellaneous itemized deductions are not deductible for individuals at all, from 2018 through tax year 2025.
So if an NFT you hold simply goes to zero value because the project collapses or the market disappears, it might be very difficult, maybe impossible, for an individual investor to claim that loss on their tax return right now.
That appears to be the unfortunate reality for many individual investors under the current rules suspending miscellaneous itemized deductions. It's a capital asset, it lost value, but without a sale, the deduction mechanism is problematic.
Is there any potential relief for theft?
The sources mention a nuance for theft losses. A theft loss incurred in a transaction entered into for profit, like an investment NFT, might be deductible as an ordinary loss in the year the theft is discovered. An ordinary loss can be more favorable than a capital loss, potentially deductible against ordinary income without the $3,000 annual limit. However,
There's always a however.
right. Proving theft to the IRS's satisfaction, documenting the value lost, and demonstrating the connection to a profit-seeking investment activity can be highly nuanced and subject to significant IRS scrutiny. It's not straightforward.
That definitely adds another layer of risk to navigating this space. And one last quick hit. The net investment income tax, or NIIT, does that apply to NFTs?
Yes, potentially. For higher income individuals, there is an additional 3.8% tax called the net investment income tax, or NIIT. This tax can apply on top of regular income or capital gains taxes to various forms of investment income.
And that includes NFT gains.
Yes, it generally includes capital gains realized from the sale of assets like NFTs, as well as potentially royalties or other investment income derived from them. This tax applies if your modified adjusted gross income exceeds certain thresholds. Currently, $200,000 for single filers, $250,000 for married filing jointly. So it's an extra potential tax hit for successful investors.
Phew. Okay. We have covered a tremendous amount of ground here, from the basic definition of an NFT and that fundamental challenge of classifying it, through all the tax implications of creating, buying with crypto, selling, trading, receiving royalties. We've tackled the nuances of that collectibles rate and the look-through analysis, navigated the evolving regulatory landscape and the associated risks, discussed the accounting complexities for businesses.
Right.
Highlighted the coming wave of information reporting, and explored strategies for managing tax, along with some of those less common, trickier loss scenarios.
It's abundantly clear, isn't it? Taxing NFTs is anything but simple or straightforward. As the sources repeatedly demonstrate, the tax treatment depends entirely on what the thing is, the specific rights and obligations it represents, and then how you or your company are engaging with it. Are you a creator, an investor, a platform, a business user? It all matters.
And the landscape is just incredibly dynamic, still very much under development. The sheer speed of innovation in the NFT space and the sheer variety of use cases emerging.
Yep.
It just feels like tax authorities are constantly playing catch-up, trying to apply old rules to brand new technology.
And that gap, that lag between the innovation and the established rules is precisely what creates so much of the complexity and the uncertainty we've been discussing throughout this deep dive.
If there's one single most important thing you want the listener to take away from all this information we've covered, the number one action item.
Beyond a shadow of doubt, documentation, documentation, documentation. Seriously, every single source stresses this point. Keep meticulous, detailed records of every single NFT transaction you engage in.
What does that mean specifically? What should people track?
It means dates of acquisition and disposition, the exact cost basis, and that must include all associated fees, plus the US dollar value of any crypto used at the exact time of the transaction. The proceeds received from sales, again in US dollars. Details of any trades or swaps, including the fair market value of what you received at the time. Details of airdrops, date received, value when received, and, if possible, copies of terms, conditions, or agreements that define what rights your NFT actually gives you.
That sounds like a lot of work.
It is, but accurate records are your absolute foundation. They're necessary for correctly calculating your basis, your gains, your losses, and for fulfilling your reporting obligations accurately. Especially with that increase in third-party reporting coming, which might not capture everything perfectly anyway. Good records are your best friend come tax time.
And it's probably worth reiterating, given all this complexity and the constantly evolving rules, that professional advice is highly recommended, wouldn't you say?
Absolutely. Without question. The IRS is actively working on guidance. We saw that with Notice 2023-27 on collectibles and the upcoming broker reporting rules. The interpretations and applications of existing tax law to new NFT use cases are constantly being debated by tax professionals. Trying to navigate the space accurately without consulting a qualified tax professional who genuinely understands digital assets is, frankly, taking on significant risk.
Yeah, this is definitely not a DIY tax area for most people, it seems.
Prudence really demands expert guidance in this rapidly changing environment. Find someone who knows this space.
Okay, so to leave you, our listener, with a final thought, something to maybe ponder as you process all this information. As NFTs continue to push boundaries, as they keep blurring the lines between purely digital assets, real-world connections, intangible experiences, community memberships, and even complex financial instruments, how will our tax systems, which were fundamentally designed for a world of physical property and traditional financial assets, truly adapt?
That's the big question, isn't it?
And maybe even more interestingly, what entirely new forms of value exchange and interaction might this technology enable in the future that could challenge our very concepts of what is taxable and how we even measure it? It's a fascinating question, I think, that underscores just how revolutionary and complex this whole space truly is.
A look ahead at the potential future of value, indeed, and how we tax it.
Indeed. Until our next deep dive, keep digging deeper.